Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about the QQQ. That is an ETF that tracks the NASDAQ. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about a short call spread in the QQQ. Right now, I'm highlighting the short call spread inside the options playbook. And that spread is a neutral to bearish trade. When we sell the spread using out of the money option contracts, so we're selling an option contract that's out of the money, and then we're buying an option contract for protection that's even further out of the money. The goal of that trade is that you get either some time decay, which means if the market just stays where it's at, the options decay and eventually make you some money over time, or you get the market to go down and then you can make money a little bit quicker on the trade if the market actually goes down. So on this week's Stock Play of the Day, and as always, it's not meant to be a recommendation, but on this week's Stock Play of the Day, so far it seems like things have worked out. So let's go in and look at the chart on the QQQ, which I'm highlighting inside the Ally Invest charting platform. And you will see that this is well, first of all, let me mention that this is a 15-minute chart. So on Tuesday, that was the 7th, we do it at noon Eastern time. It's always a live show, so we're dealing with live quotes. At the beginning of the hour, we actually had a little bit of a move up during the call. Actually, the biggest move up, or the highest point of the week, actually happened during the call, right around here. Well, that was 12:50. Right there was 12:30. So at the end of the call, it was kind of at the height of the market, if you will. From that point on, a little choppy, closed a little bit back down, back to where we started the call. All day Wednesday, these are 15-minute bars, actually got all the way down to 378.42 and bounced back up, came back down, and now we are seeing we're trading. This is live about at around 378.59 overall on a 15-minute basis. So let's get to the trade. The actual trade that we looked at, we know it's a short call spread. We see that the QQQ is down a little bit, just a fraction, about 0.1%, down 41 cents. The expiration that we chose was the September 24th expiration. Now there's 14 days remaining, so that's so far since Tuesday. We've had a few days go away, and this is where we're at. The market is obviously down. That's the direction that we wanted it to go, but it isn't down that much. It's down about 0.5% since Tuesday. We sold the 389 strike call and we bought the 391 strike call. As I mentioned, this is the call side of the chain, by the way. So we were out of the money. And I'll scroll down before I get to where it's trading at, and I'll kind of show you on the profit and loss graph. We saw the profit and loss graph inside the options playbook. That's at expiration. So that would be representative of the dotted line on the live profit and loss graph inside the Ally Invest option chains. But here's where the underlying market is at. So this is as of today. If you were to put on this call, that's what this profit and loss graph is representing. This is the strike that we're worried about, the 389 strike. One of the things that happens is, you're going to get a little bit more time decay over the next 14 days, but the trade has done fairly well considering we've only had, half a day on Tuesday, all day Wednesday, all day Thursday, and now half a day on Friday. And if we look at the actual trade, and I'm going to put it in the right rail here. And if we look at that right now, when we did the trade, the underlying was trading right around 53 cents. So right now, half of the premium has been made. It's trading right around 25 cents at this point in time, meaning you'd be up 25 cents. The maximum you can make on the trade is 50 cents. So what I would probably do is just have an order in to buy back maybe around 15 cents or so, just to close it out if it gets down to that range, especially considering we still have 14 days remaining. this would be a fairly decent point to get out of the trade. The trade is the QQQ isn't really making a move in either direction. It's just kind of chop, but we've got a good amount of decay just over the 4-day period that we're talking about so far. So maybe you close it out. And if you were to just close it out right now, as I mentioned, not meant to be a recommendation, but the steps that we would go through to close out this trade inside our platform would be for every buy to open, we would actually change that order entry to a sell to close. And for every sell to open, that's when we're opening the position, we would put that in as a buy to close. And you'll notice now that that midpoint that I'm highlighting here is trading at a net debit. Click on that net debit. That would make it a limit order. I always want to do limit orders, especially on spreads. And a lot of times you're targeting something around the midpoint. You're never guaranteed a midpoint fill. And always remember that with options, you do have to pay commission. So you always want to factor that into your profit and loss overall. So we would be selling to close one of the September 24th expiration 391 strike calls, and then buying to close that same expiration 389 strike call. If we worked it at the midpoint, we'd be looking for a net debit to remove our risk of 26 cents. It looks like that's where it's at right now. And it's a fairly straightforward trade. We didn't go out that far in time. There really are no adjustments at this point in time because we are doing okay on that trade overall. So we just let it ride. Now, if I wanted to, just as a point of managing or trying to take it off your plate, there's no guarantee that it would get there overall. But you might think about a good till canceled order. That means that it's going to be out there for at least 60 days or at least to the expiration of these option contracts, and say, you know what, I wouldn't mind if I'm just going to let this sit in there at 15 cents. And if it gets down to 15 cents, well, I'll gladly close it out at that level. So that's one way that you can target a potential gain if the market keeps moving in your direction, or we get a little bit more time decay on this trade. We've already had a lot of time decay considering we put the trade on Tuesday. Market's only down about 0.5% or about 2.5 points. And we were already see about half of our premium is all it takes to buy the trade back and close it out. That's going to be it for this edition of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and you'll get all the reminders for this next Tuesday's Stock Play of the Day. Thanks for coming, everyone.